Throughout history, economies have risen and fallen, with each collapse leaving millions of ordinary people in financial ruin, while a select few emerge wealthier and more powerful. Each crisis is framed as an unfortunate consequence of market forces, unpredictable global events, or policy miscalculations. But a deeper look at the mechanisms behind these financial catastrophes raises unsettling questions. Are these collapses truly accidental? Or is there an underlying structure ensuring that wealth is systematically transferred from the many to the few? The patterns of financial collapses are eerily similar, following a sequence where mass participation in a seemingly booming economy is encouraged, only for the market to be deliberately destabilized when the time is right. Central banks, financial institutions, and government policies all play a role in this cycle, raising the possibility that financial disasters are not just misfortunes, but carefully orchestrated events serving the interests of those who control the global financial system. Markets operate on the principle of supply and demand, but human psychology plays an equally significant role. Booms begin with optimism as low interest rates and easy credit flood the system. Governments and financial institutions encourage investment, media outlets fuel the hype, and the general public, eager not to be left behind, pours their savings into stocks, real estate, or speculative markets. Asset prices skyrocket, creating an illusion of endless prosperity. At the same time, institutional investors and financial elites who understand the cyclical nature of these patterns quietly prepare their exit strategies. They do not act on emotions or media narratives. They analyze data, study historical trends, and recognize when an overheated market is on the verge of collapse. The moment retail investors feel safest is often the moment the collapse is imminent. The game is rigged in favor of those who set the rules, and history has proven that markets do not crash when small investors begin to sell, but when those at the top have already made their moves. What follows is a swift and brutal market downturn. Triggers for the crash may vary. Interest rate hikes, a sudden liquidity crisis, geopolitical instability, or a high profile corporate bankruptcy, but the outcome is always the same. The masses who believed in the system watch their savings, investments, and retirement funds evaporate overnight. Panic spreads, fear dominates, and investors rush to sell whatever they can, further accelerating the collapse. In contrast, the financial elite, who have already shifted their capital to safer assets or bet against the market, are now positioned to acquire distressed assets at record low prices. While the public loses homes, jobs, and businesses, powerful banking institutions and hedge funds scoop up land, stocks, and entire companies for pennies on the dollar. These entities do not fear financial downturns. They are opportunities to consolidate power and expand influence. Governments, rather than holding financial institutions accountable, step in with bailouts that disproportionately benefit large corporations and banks. They justify these actions under the guise of preserving financial stability, but in reality, the same reckless institutions responsible for triggering the crisis are rewarded with taxpayer funded rescues. Meanwhile, the average person who played by the rules is left struggling with job losses, rising debt, and a bleak financial future. Laws are rewritten to ensure that future collapses will have even fewer consequences for those who operate at the highest levels of finance. The public is fed a narrative that markets are unpredictable, that such crises are inevitable, and that economic recovery depends on continued faith in the very system that betrayed them. The wealth gap WAP widens with each crisis. Ordinary citizens are burdened with higher taxes, reduced social services, and an economy that serves corporate interests above all else. Meanwhile, those who orchestrated the collapse use their newfound wealth to buy political influence, ensuring that regulations remain weak and future financial crises will be even more profitable. The cycle repeats: boom, bust, consolidation, expansion, always with the same winners and losers. What appears to be economic misfortune may, in fact, be a carefully calculated strategy to shift wealth from the many to the few. Whether by accident or design, the result remains the same. Financial collapses create poverty for millions and unimaginable riches for those who control the system.